Silver didn't dip today. It didn't cool off. It got hit with a kill switch. Here's what happened fast. On Tuesday, January 27, 2026, silver ripped to about $117.73 an ounce, printed a new all-time high, and then got shoved off a cliff. In roughly 4 hours, it was trading near $103.89. That's a double-digit dollar drop so violent it erased weeks of momentum before lunch. If you were watching the tape, you felt the mood flip in minutes. One moment it was euphoria, bids stacking, everyone talking like the breakout was confirmed. The next moment the air went thin, liquidity vanished, stops started tripping, and the selling didn't look human. It looked automatic. I'm your host, and this is where we decode the moves they don't explain. Now let's break down what really just happened. Before we go deeper, do this one thing: tap subscribe. If you want no-fluff market breakdowns and the mechanics mainstream headlines skip, you'll want the next videos too. And drop a comment with one word: locked. I want to see how many of you are actually tracking this, not just watching the chart like it's a slot machine. Now listen carefully, because this move was not normal. Markets do not naturally delete $14 in a few hours in a metal that trades like a freight train. That kind of snap is not supply and demand politely finding balance. That kind of snap is rules changing mid-game, leverage getting strangled, and forced selling doing the dirty work for whoever needed relief. And yes, someone needed relief. This rally was turning into a problem. Not for miners, not for people buying coins, for the paper system that sets the silver price on a screen. For the shorts who were getting squeezed, contract by contract, tick by tick. So the first question is simple. What button can stop a silver squeeze instantly? It's not a scary headline. It's not a Fed speech. It's not even a dump of physical bars. It's margin. Margin is the quietest weapon on the exchange. It sounds boring, which is why it's effective. And it can vaporize a rally without ever admitting that's what it's doing. Here's the mechanism in plain English. On the futures exchange, you don't pay for all the silver you control. You post a deposit, a fraction, a bond. That deposit lets you control a contract that represents thousands of ounces. That leverage is gasoline. It makes trends accelerate. It also makes traders fragile, because the exchange can raise the deposit. When margin goes up, every leveraged long has a timer put on their head. Add more cash immediately, or get liquidated. That's not a warning. That's a forced sale. And when a large percentage of the market is leveraged, a margin hike doesn't just reduce risk. It forces a wave of selling regardless of fundamentals. According to the script you're working from, the exchange raised silver futures margin requirements by roughly 47%, pushing maintenance margin from about $22,000 per contract to around $32,500. Translate that into human language. If you're holding positions, you suddenly need thousands more per contract right now, not tomorrow, not next week. So what happens next? The weakest hands aren't the people with the worst analysis. They're the people with the least spare cash. Traders get margin calls. Funds get margin calls. Prop desks tighten. Retail accounts get auto-liquidated. And the market becomes a waterfall. Not because everyone turned bearish, but because everyone is being forced through the same narrow exit. That's what you watched. And the timing is the tell. Margin hikes don't usually arrive when a market is calm. They arrive when a market is dangerous for the wrong side. Silver had been running hot. Shorts were bleeding. Momentum was feeding on itself. And the higher silver climbed, the more margin the shorts needed, the more collateral they had to post, and the closer they got to the point where the squeeze becomes existential. So the exchange raises margin, and suddenly it's the longs who can't breathe. Do you see the inversion? They didn't have to ban buying. They didn't have to halt trading. They just made it too expensive to stay long with leverage. It's like raising the oxygen tax in a room full of runners. Now, if you think this sounds dramatic, you need to understand history, because this playbook has fingerprints. When silver surged in 1980, the rules changed. Restrictions arrived. The rally died. When silver ran toward the highs in 2011, the exchange didn't raise margin once. It raised it repeatedly in a tight window, and silver went from near its peak to a brutal retrace. Patterns matter, not because history repeats perfectly, but because systems repeat incentives. And the incentive here is obvious. When a squeeze threatens the integrity of the paper market protects itself. Now let's go one layer deeper, because margin is the weapon, but the target matters. Who was trapped? The script points to a large commercial net short position, hundreds of millions of ounces equivalent on paper. If you're net short that size, every $1 move higher is not volatility, it's pain. Every $10 move higher is a potential crisis. Every $30 move higher is a boardroom meeting. So when silver runs from the 80s toward the 110s, the shorts don't just watch, they fight. And they don't fight on television, they fight in structure. You've heard of spoofing, the practice where fake orders are used to nudge price and trigger reactions. That's not internet folklore. A major bank paid a massive fine for precious metals manipulation in recent years, including spoofing activity. Here's why that matters. If the same institutions that have been caught gaming the market are also among the biggest players in the silver ecosystem, you should not be surprised when the market behaves like a rigged arcade. I'm not saying every tick is fake. I'm saying the levers exist, and they get pulled hardest when the consequences are biggest. Today's consequences were enormous. A fresh all-time high is not just a chart event. It's a psychological event. It tells the world the old ceiling is gone. It invites momentum money. It invites the public. It invites headlines. And it invites one thing the shorts fear: belief. Because when enough people believe a breakout is real, they stop trading paper and start demanding metal. That is what breaks the system. So the system tries to break belief first, crash it fast, make it feel unsafe, turn celebration into nausea. If you can make people associate silver with pain, you can slow the stampede. And here's the irony. They can smash the screen price, but they cannot smash the physical reality. This is where the story gets uncomfortable for the paper market. While futures were getting shoved around in New York, the physical market was telling a different story. In pockets of the world, buyers were reportedly paying far above the screen price. Not a little premium, a chasm. That gap is the real signal. Because paper can trade infinite ounces that don't exist. Physical can't. If someone in Asia is paying $130 while the screen prints $111, you're not looking at a healthy arbitrage. You're looking at a credibility crisis. This is what I call the divorce. Two prices, two realities, one metal. And when that divorce widens, it tells you something simple. The price is not the same thing as cost to acquire. If the only price you can actually buy at is higher, then the lower price is a story, not a market. Now ask yourself, why would physical be tight right now? Start with inventories. Registered exchange inventories, the metal actually eligible for delivery, have been falling for years in many narratives. And when withdrawals accelerate in short windows, it's a red siren. The script mentions tens of millions of ounces being pulled for delivery in a short stretch, including a chunk that represents a meaningful percentage of what's considered deliverable. Whether you take those exact numbers or not, the direction is what matters. Metal leaving the system signals rising distrust. Because in a normal world, traders roll contracts, cash settle, and keep playing the paper game. When confidence breaks, they say, "No, I want the bars." That demand for delivery is what the paper system cannot tolerate at scale. Because the paper system works only if most people don't ask for the thing the contract represents. So the exchange uses margin to discourage that behavior by making it painful to hold long positions. That's the tug of war you're watching. Now layer in geopolitics, because silver is not just jewelry, it's infrastructure. It sits in solar panels. It sits in electronics. It sits in high-performance components. It sits in the wiring and contacts of the modern economy. And when governments start treating metals like strategic supplies, markets stop behaving like polite spreadsheets. The script says China tightened export control around silver, reclassifying it as strategic, requiring licensing, and limiting the number of exporters. Whether every detail is perfect is not the point here. You told me not to verify. The point is the theme. When a major industrial hub chokes export flow, the world feels it in premiums first, not headlines. Premiums are the truth serum of commodities. If there's plenty of supply, premiums collapse. If supply is tight, premiums explode. So if you're watching a screen and thinking, silver crashed, but you go to buy and the dealer is still charging a monster premium, that tells you the crash is mostly paper. Now, the next question is brutal. Who got destroyed in this? Not the people holding a few coins in a drawer. Not the people stacking bars with cash. The casualties are the leveraged paper players. The script references a wave of insolvencies among silver trading firms in India, tied to margin calls and volatility, with liabilities in the hundreds of millions. That story is believable because leverage plus rule changes equals sudden death. And it exposes the trap in one sentence. You can be right about silver and still get wiped out if you're right in the wrong vehicle. Futures are not silver. They are a contract inside a rulebook, and the rulebook can change. Physical is silver. It has no margin clerk. It has no forced liquidation. It doesn't care what the exchange does at 10:30 a.m. So if you're sitting there feeling sick because the screen price dropped, you need to separate these two worlds in your head. Paper world: leverage, margin, liquidation, volatility. Physical world: supply, demand, delivery, scarcity. Today was a paper event. Now let's talk about why the hit happened today specifically. Because an all-time high is a magnet. It attracts the dumb money, but it also attracts the smartest money. Smart money knows that when a market prints a new extreme, the exchange is watching. Risk managers are watching. Shorts are watching. And if the market is going to get hit, it often gets hit right when confidence is maximal. That's the maximum psychological damage. If you drop silver from $117 to $104, you don't just hurt traders. You rewrite the emotional memory of everyone who just watched their guaranteed breakout get punched in the mouth. That slows new buying. That gives shorts time. That gives the system breathing room. So if you're asking why now, the answer is because this is when it works. But here's the part that should keep you glued to the next 5 minutes of this video. If they needed to hit it this hard, it means the pressure underneath is still rising. Think about it. If this rally was truly a flimsy bubble, you wouldn't need a 47% margin hike to pop it. You'd let it pop naturally. You'd let sellers take it down. The fact they used a sledgehammer suggests they didn't trust a gentle push. So what happens next? There are 3 endgames and all of them are volatile, but only one of them is good for paper shorts. Endgame 1, the reset. The paper market eventually lets price float higher to reconnect with physical reality. That means the screen price moves toward the premium, not the other way around. In that scenario, the smash is a temporary detour, and the next leg up is vicious because it starts with distrust. Endgame 2, the permanent split. Paper keeps trading in its own sandbox, while physical trades with a parallel premium that becomes normal. 2 prices become standard. Futures become less relevant as a price signal. Physical holders win because the real clearing price is set where metal actually changes hands. Endgame 3, the break. Delivery demand spikes at the wrong moment, inventories can't meet obligations, and the exchange leans on cash settlement, delays, rule changes, emergency measures, whatever language you want. In that moment, the paper price becomes a number people laugh at, and physical becomes king. Which one is most likely? It depends on confidence. Confidence is the fuel, and confidence is what today just burned. But there's a catch, because panic doesn't only drive selling, it also drives conversion. When traders get traumatized by paper volatility, a percentage of them stop playing paper and start buying metal. That's how the system can accidentally accelerate its own collapse. By protecting itself, it educates its customers. Now, I want to get practical, because this is where most people either get smarter or get scammed. If you're holding physical silver, the worst move you can make is letting a paper event trigger a physical decision. Physical holders don't get margin called. If you sell because of a margin hike, you're letting someone else's forced liquidation become your voluntary liquidation. If you're holding leveraged paper, you must understand you are not just betting on direction. You are betting on rules staying stable. Today showed you rules are a variable. So here are the only questions that matter for you right now. 1. Do you actually own silver, or do you own a promise tied to a rulebook? 2. If the screen price drops again tomorrow, can you hold without being forced out? 3. If the screen price rockets back to highs, can you hold without getting shaken out by volatility? Write your answer in the comments. Are you holding physical, paper, or both? And what price level would you consider adding, not selling? Now, there's one more layer people ignore: perception management. When a market collapses fast, the headlines will rush to label it bubble, speculative mania, retail frenzy. That language is not neutral. It's designed to make you feel dumb for being interested. But fundamentals didn't change in 4 hours. Mines didn't suddenly double production at 11 a.m. Factories didn't stop using silver at noon. A strategic metal doesn't become worthless by lunchtime. What changed was liquidity and leverage conditions in a paper venue. That's it. So here's my challenge to you. The next time you see a headline saying, "Silver crash," don't look at the chart first. Look at the premiums. Look at inventory drawdowns. Look at lease rates if you track them. Look at availability from dealers. Those are physical signals. If physical stays tight while paper gets shoved, that's not a death sentence. That's a sale, if you're operating in the physical world. And this is where we talk about timing, because everyone wants a date. They want the exact week the paper system breaks. They want the moment of truth like it's a movie scene. Real systems don't fail on your schedule. They fail when pressure meets fragility. Pressure, rising industrial use, strategic hoarding, and investment demand that refuses to die. Fragility, low deliverable inventories, high leverage, and a pricing mechanism that requires most people not to ask for delivery. Today increased fragility because it increased distrust. So the question becomes, how many today events does it take before enough participants stop trusting the paper price? That's the countdown no one can print. Now, if you watch this and you're still here, you're not here for entertainment. You're here to understand the machine. So do me a favor. Hit like so this reaches the people who only saw the red candle and got scared. Subscribe so you don't miss the next breakdown, because the next move in silver, up or down, will tell you whether this smash actually worked or whether it just loaded the spring tighter. And I'll leave you with two questions, because I want you thinking, not reacting. If an exchange can change margin and erase $14 in hours, do you still believe futures are price discovery, or are they price control? And if physical buyers are paying far above the screen price, which number do you think matters when the shelves go empty? Drop your answers below. Keep your head. Separate paper noise from physical reality. And remember, when the system has to hit a market this hard, it's usually because something underneath is trying to break free.